September 2025, NVIDIA announces that it will invest up to $100 billion in OpenAI to help the AI startup fund a data center build-out of at least 10 gigawatts. Warrants to purchase up to 160 million AMD shares. That's nearly 10% of the company at a 1 cent per share. In exchange, OpenAI is committed to purchase 6 gigawatts of AMD GPUs, which represents about $90 billion in spend, $90 billion of revenue, and 20% of margins. AMD is getting $18 billion of EBITDA back, but at a cost of $40 billion in stock. OpenAI and Broadcom are going to work together to develop and deploy 10 gigawatts of custom AI chips over the next 4 years. And you know what the estimated deal value is? $350 billion. But here's the thing, there are more deals than just this. All in all, OpenAI has committed to $1.15 trillion of infrastructure over the next 5 years, prompting this viral clip.
How can a company with $13 billion in revenues make $1.4 trillion of spend commitments?
First of all, we're doing well more revenue than that. Second of all, Brad, if you want to sell your shares, I'll find you a buyer.
Like those with Ambiance, Harvey, and Anisphere. But these venture investments were made so that these companies could actually use the money to spend more with OpenAI. Here's how it works. OpenAI invests in startups. The startups use that money to spend with OpenAI. Based on all of this, you'd think that OpenAI is a $1 trillion company, right? Well, obviously no. According to Sam Altman, OpenAI will have an annualized run rate revenue of $20 billion by December 2025. Is OpenAI too big to fail? Annually, US companies spend around $1.2 trillion on capex per year. That is every single US company combined. This means that OpenAI is committing to spend nearly 100% of US capex over the next 5 years. 12 months of financials. Amazon, Broadcom, AMD, NVIDIA, Oracle, Microsoft, and CoreWeave have only combined to spend $225 billion in capex. Those are giant companies, and the OpenAI deal comprises of nearly 100% of that spend. Take a look at this chart. This shows how much OpenAI is expected to spend per year for the next 5 years. The number grows from $6 billion in 2025 to $295 billion in 2030. If we take OpenAI's gross margin projections at face value, that means they will need to grow actual revenue, wait for it, from $12 billion in 2025 to $983 billion in 2030. Let me illustrate how crazy this sounds. OpenAI essentially needs to grow revenue by 85x in 5 years to have even the remotest chance of making the bills. But this doesn't convey the extent of the problem. As many of you know, gross profit and profit are not the same thing. Any first-year accounting student can tell you they don't contemplate energy costs, maintenance costs, leases, debt servicing costs, and more.
And so this is where we're looking for an ecosystem of banks, private equity, maybe even governmental, the ways governments can come to bear.
That way, if OpenAI can't meet those obligations, the taxpayers will be on the hook. But this is bigger than OpenAI. There are hundreds of AI companies. AI for dating, AI for voice, AI for video, AI for AI. For example, Anthropic has raised 27 billion USD and it's currently valued at 183 billion. They've also committed to purchase $30 billion of Azure compute capacity from Microsoft, and possibly $14 billion with Amazon. What about Meta? Firstly, Meta bought Scale AI for $14.9 billion, which was a joke. Let's list off everything that they're planning to do. They're projected to spend $70 billion on data centers. They went on a hiring spree and are spending $1 billion in wages for the top AI talent. And there's already reports that people either turn down those pay packages or are leaving to go back to their previous jobs or starting their own companies. To make all of this math work, Bain estimates that $2 trillion of new revenue is needed. That is 7% of US GDP. So what do I mean by this? Well, the spending commitments being made by OpenAI and others are all interconnected and super complicated. Let's give an example with pretty graphics to explain. Microsoft has invested over $13 billion into OpenAI's for-profit arm for equity and a revenue share. But much of this $13 billion is not cash, but instead it is Azure Cloud Computing credits, meaning Microsoft is investing in OpenAI so that OpenAI can buy Microsoft products. But it gets better. Because this deal means OpenAI is using a ton of Azure capacity, Microsoft needs to expand and improve its Azure data centers. So Microsoft takes this booked revenue from OpenAI and places massive orders with Nvidia for millions of GPUs so that it can handle the commitments to OpenAI. So essentially, Microsoft is investing in OpenAI so OpenAI can buy from Microsoft so Microsoft can buy from Nvidia. And now that Nvidia has a bunch of money coming in, a new loop starts to emerge. Nvidia takes that money from Microsoft and others and makes a commitment, you're not going to believe this, to invest up to $100 billion in OpenAI. OpenAI then commits to using that investment to purchase a huge volume of Nvidia chips. And with that leftover money, OpenAI can pay off others like Microsoft. So Nvidia pays OpenAI so OpenAI can pay Nvidia and also pay Microsoft so that Microsoft can invest in OpenAI so that OpenAI can buy from Microsoft so that Microsoft can buy from Nvidia so that Nvidia can invest in OpenAI and so on and so on and so on. Because the revenue of one company is the cost of another company is the investment of another company. This money flows from entity to entity, making it difficult to understand what is real, what is news, and what is garbage. Layer on the fact that many of these deals have a ton of complex contingencies and financial instruments, then it becomes impossible to assess the quality of cash flows. And many people are concerned that the AI bubble looks a lot like the 2008 Great Financial Crisis and the 90s tech bubble. But is it true? Alright, firstly, let's look at the Great Financial Crisis. The GFC led to nearly 9 million people losing their jobs and household net worth falling by $11 trillion. These low-quality mortgages represent approximately 20% of all US mortgages, or $2.2 trillion. And this is when the house of cards began to collapse. Over $500 billion of those loans began to default, which led to a systemic loss. And the AI situation is slightly different. OpenAI's obligations are not being securitized and spun off into exotic derivatives, multiplying that global exposure. What's more is that unlike many of the institutions in the GFC, the big tech players have a lot of cash. But what about the tech bubble? Well, this one is a bit more interesting. From 1995 to its peak in March 2000, the Nasdaq surged by 572%. But in 99, the Fed started raising interest rates and investors started asking about profits only to find none. Panic set in, and by October 2002, $5 trillion in market value was wiped out. During this time, the Nasdaq 100 was trading at a forward PE ratio of 60x. Today, that number is 30x, which is 50% cheaper. What's more is that very few of these companies were profitable, whereas today, all the major tech companies are super profitable. That said, yes, the AI bubble doesn't have the debt and derivatives of the GFC. It doesn't have the same froth of the dot-com bubble, but it does have trillions of intercompany dealings, questionable earnings, relatively high valuations, an underlying economy that cannot sustain low interest rates, and way too much AI slop if we're being honest.